Are you someone who thinks Tesla is the best way to play robotaxis? Well, after today's video, you may change your mind. Sure, Tesla's got loads of big data and even bigger plans, but we're focused on what's actually happening today, and we think there might be a better way to play autonomy. If you're invested in Uber or Tesla, then this is a piece that you don't want to miss. So let's talk about autonomy today. Waymo has achieved the most progress in the US, so we equate progress to revenues being generated by robotaxis that are carrying passengers. And let's forget for a second about what their cost of goods sold might look like. So based on back-of-the-napkin math, Waymo seems to be bringing in between 39 million and 78 million per year on about 600,000 rides. So you put that in the context of Uber's $20 billion in mobility in 2023, then certainly this is not a very significant amount. But the other thing to consider here is that these expensive vehicles are likely to be heavily subsidized. Now, when we take a global look at autonomy, China's understandably taking the lead. I think that regulatory hurdles there are going to be laxed so that the CCP can say that they're winning even though they're not allowed the hardware that they'd like. Baidu has been testing its service in about 10 cities and probably, according to Bloomberg, notice the word probably, even they don't have a clear indicator of who the leader is, has the largest fleet in the country with more than 600 vehicles as of 2023. And a recent IPO, WeRide. This is a Chinese firm that's having an IPO in the United States, and here you can see a breakdown of their financials. First of all, the VI structure is a showstopper, so we don't invest in companies where we don't have any legal obligation to own the shares that we're led to believe that we own. But the thing to note here, I think, is that services revenue is declining in 2024 for some reason. So it's certainly a way to play Chinese autonomy, but not something that we'd be interested in. So the most recent piece that we wrote on autonomy, you'll see a number of pieces here under our tag autonomous vehicles. This piece, is autonomy a threat or an opportunity for Uber? And you ought to give that a read because it's quite interesting. And when we look at what Uber does, I like this chart here on the left. It shows breakdown by segment. So you see their mobility and delivery accounting for what it appears to be over 90% of Uber's business. What's rather discouraging here would be the EBITDA margins, so essentially the profitability of each segment. Look at delivery, and that makes sense, right? Because you don't want to pay a whole lot to have your food delivered, whilst you might pay a lot more for a ride. So you see that mobility there is almost 3 times as profitable for Uber, and we've compared them to Grab. We also did a piece looking at Grab, and they had a similar profitability in their segments that are the same as Uber. So what's attractive here is that these extremely low margins, especially for delivery, could be improved a lot with autonomy. And how much could they be improved? Well, we've always thrown around this 30% number, so the driver is 30% of the cost, and that really may be lowballing it. When Uber pays drivers less, per this piece by Forbes, their take rate increases, that's intuitive, and so do profits. So paying drivers less. What about not having to pay drivers, right? So delivery certainly might be easiest for them to enable autonomy for, since it's not carrying passengers. And as I said, it stands to have the most impact on margins. Now, when we look at this little back of the napkin math here that Forbes did in that piece, they put driver pay at around 60% of the total ride price for mobility. So what that means is that the most profitable segment for Uber right now, mobility, could become much more profitable. Now, what is Uber doing for autonomy? This is what we dug into in our recent piece, and what we found out was rather surprising. So they're now offering Waymo vehicles via their app. So whilst Waymo has their own app that operates in, I think, 3 or 4 cities, they've now partnered with Uber, and essentially you can hail a Waymo using Uber's app. They've also partnered with 10 different companies on autonomy, and that's across all of their segments, from freight to delivery to mobility. So Uber wants to put themselves in a position where they stand to benefit regardless of who comes ahead in the race to develop full autonomy or robotaxis. And what they can then do is choose to acquire those vehicles or technologies that come out ahead after kicking the tires a bit. Now, if the business has sufficient growth ahead, that means Uber minus autonomy, then the benefits from autonomy may simply be the icing on the cake. We look at the autonomous technology partners of Uber listed here. It's rather interesting, especially those robots there that are planning on doing sidewalk delivery. I certainly remain skeptical about how widespread those might become, but it's interesting to see they're making some progress. And the one point of contention that we've always had is whether or not autonomy is going to significantly expand Uber's total addressable market. And they seem to think it will, obviously, but we've never been convinced that decreasing prices will result in a corresponding increase in demand. And that may be quite a rookie mistake. Now, when we simply look at the total addressable market for Uber in terms of countries where they haven't achieved a whole lot of penetration yet, you see here they're saying we're planting the seeds for consistent consumer growth in huge new countries where Uber is not yet a verb, right? You have Spain, Japan, Argentina, Germany, South Korea, and they're showing how in 2021 there was $1 billion coming from these countries, and that's moved to $3 billion in 2023. Of course, you can look in their financials for geographic breakdown. It's not this granular, but they're telling us that there's an opportunity to expand TAM beyond just autonomy decreasing prices. And we really want to pay attention to this, what we call the TAM problem here. So famed finance professor Aswath Damodaran made a big mistake when calculating Uber's TAM. And you see this piece he wrote here, Uber isn't worth $17 billion. Now, he estimated the historical taxi and limousine market at a $100 billion global TAM, and he was probably right. But he assumed that a service like Uber would have zero impact on the overall market size of the car for hire transportation market. Now, Bill Gurley, his gentleman here that turned his $12 million investment into Uber in 2011 into $7 billion when they IPO'd. I think there's, a 55,000% return there. Here's what he had to say about Uber's TAM in a 2014 piece that's definitely worth a read. He said, my goal is to offer a plausible argument that the core assumptions used in Damodaran's analysis may be off by a factor of 25 times. So let's say it's not a $100 billion TAM, it's a $2.5 trillion TAM. This goes to ARC's opinions about what the Robotaxi TAM might look like. And he makes a number of interesting points here on why. So first of all, pickup times. So in cities where Uber has high liquidity, you have pickup times of less than 5 minutes. So it's quite convenient. Coverage density. So as Uber evolves in a city, the geographic area they serve grows and grows. This picture on the right by David Sachs, it's titled Uber's Virtuous Cycle. Geographic density is the new network effect, meaning that the more drivers you have, the faster the pickups, the lower the price, the more people take it. And it's just a network effect there that's hard to beat or hard to compete with, right? If you're trying to compete with Uber, and not many are able to. Uber's definitely a leader in what they do, at least when it comes to mobility. Now, payment as well. So Uber, you never need cash. I can tell you that's a lifesaver. I've used Ubers all over this planet in all continents and except Antarctica. And I can tell you that this works magic, not having to deal with cash. Though occasionally you'll catch an Uber driver who will say, the app said that you're supposed to pay me cash. And in fact, it's selected credit. And you get a little argument. And then they realize that they should back down. Otherwise, they don't get a good rating. Again, rating here, they say the dual rating system in Uber leads to much more civil experience. Indeed, it does. Trust and safety. So I've never had, I've had problems before using ride sharing, but I don't believe that those were with Uber. Additional use cases. This is rather interesting in a piece from 2014. So using Uber in less urban areas, we see that. Rental car alternative, again, that's going to price there, and flexibility, availability, a night out, right? So I don't know how common it is in other countries. Americans do a lot of drinking and driving. They just don't get caught. And being able to hail an Uber very quickly is certainly helped those who like nights out. Transporting kids or older parents, you see Uber trying to pivot this Uber Health offering. Essentially, it's just an Uber that you can take, right? Or Uber's airport transport, right? Maybe, perhaps they're adding some element of fixed cost or some features to it. But a supplement for mass transit. So that's a big one, man. I can tell you, when I was living in London, I recall an hour and a half each way to work in the morning. And if I could have cut that time down for a reasonable price, I would have done that in a second. A car replacement, this is an interesting one. So he says, first, the consumer is going to replace their extra car. Most Americans have a second car, believe it or not. And then next, consumers with an aversion to driving will switch to Uber. So if you like to have a drink after work, or if you like to be on your smartphone all the time, it's certainly more appealing to have somebody else driving. Demographic preferences. I've always thought that people love driving. I love driving, and maybe I shouldn't think that, but he points to young people not being overly keen to drive. And what this translates to, which is rather interesting, is this new TAM that Mr. Gurley has come up with here. And it's anywhere from $450 billion to $1.35 trillion. Now, so I guess the takeaway there is that there's probably a lot of total addressable market expansion opportunity for Uber. Now, before we get into valuation, a word from Wyatt for premium subscribers.
One of my many roles here at Nanalyze is helping to answer support tickets from our lovely base of subscribers. In fact, some of you might recognize my name from our email exchanges. We really pride ourselves on superior customer service and helping you guys navigate all the great content we produce. So if any of you would like to read Gurley's 2014 piece on Uber's massive TAM, just respond to any of our emails and myself or Joe will send you the report. Or if you're just lonely and want to chat, we're here for that too.
Thanks, Wyatt, and thank you to all the premium subscribers that make this possible. So let's talk about Uber's valuation. Now, when it comes to performance, because everybody likes to look at that, Uber has underperformed the NASDAQ, but they're not a tech stock. This is rather interesting. A lot of people don't know this. Uber's classified as an industrials stock, so you need to use the appropriate benchmark. But regardless, less than 5 years of performance data doesn't tell us much. We're more interested in looking at valuation. So prior to their IPO, the last private market valuation was about $76 billion. First day of trading, they closed at a market cap of $70 billion. So some thought they were going to offer around $120 billion. But compare that then to today's market cap of $151 billion and a simple valuation ratio of around 3. So that's something we use here at Nanalyze. It's market cap divided by annualized revenues, simple valuation ratio, right? You can compare that to our catalog average of 5.5. Now, the reason that we use that is because most disruptive technology companies aren't profitable yet. So now that Uber is starting to become profitable, moving to price to earnings probably makes sense, and then it's not so cheap, of course, right? But you need to consider the potential of increased profitability with autonomy, and I think that dwarfs all the claims they make on their February investor deck about all these levers they have to push to increase profitability. Autonomy is the big one, right? Now, I know inevitably, based on the title of this presentation, you're going to ask, well, what about Tesla? And you should. Tesla sells autonomous vehicles. Uber rents them. And utilization is what's going to produce the maximum income here. So for a Tesla to be fully utilized, it needs a pipeline of demand. And Uber's CEO recently discussed how he doesn't believe vehicle owners are going to be so keen to share their cars with strangers. What about customer support infrastructure? Who do you call if your Tesla is late to arrive because it's stuck somewhere in traffic trying to deliver somebody's Olive Garden? So it seems like it would be in Tesla's best interest to use Uber's app, and that's what he was implying in the latest Uber investor deck, their earnings deck. You see the first slide talk about how their platform is the perfect solution for companies developing autonomous technology. So the other option here, of course, is to say, well, does X become the everything app and everyone uses it for hailing Teslas? Well, I don't know, but it's going to be very difficult to duplicate the platform that Uber has and all the data and efficiencies that they've managed to engineer into it over the years. So just some concluding thoughts here. A robotaxi company is one that's realizing revenues from passenger fares. Tesla's not a robotaxi company yet. Now, Uber has robotaxis operating today, courtesy of Waymo. So the question there, as we talked about in our piece, is on what terms, right? And of course, Waymo needs to get to a point where they can operate profitably. It's highly unlikely that they're currently profitable, and that costs a lot of money to keep that going. Now, we feel more assured, I think, after today's presentation that decreasing price points as a function of autonomy for ride hailing will increase demand and use cases. Just that Gurley piece from 10 years ago really shines a lot of light on how TAM can expand when price lowers. Now, Uber saw $20 billion in mobility revenues for 2023. On the right-hand side here, you can see their total revenues and their growth. It's fairly impressive growth, right, for an industrials firm. So that means that according to Damodaran's estimate of $100 billion total addressable market, they have 20% market share. So just based on that, there's a lot of upside to be realized here. So with that upside, you get some downside protection, I think, for the autonomy thesis at a reasonable valuation. Now, I think there's some concerns to be had around the decline in their freight segment, but that's probably a topic for a different day. Question for the class: what do you think about Uber being a better play on autonomy than Tesla? And I'd really like to hear your comments on that. And speaking of the devil, could Tesla really hit $2,600 per share? Well, only if autonomy comes into play in a big way. You ought to watch this piece, which talks about how ARK put together a model that's very useful in valuing Tesla based on their autonomous aspirations. Thank you so much for taking the time to watch this today.